I have spent the last 2 days in the TCFD plenary meeting. We meet every 2 months. We have a fairly full work schedule, 2021 coming through to 2022. I'll touch on a little bit of that. But really what I wanted to talk about net zero. But the reason for mentioning the TCFD goes to the heart of what we're talking about here. We've been talking about metrics and targets. We put out a consultation paper saying what is the right metric for financial institutions that is both forward-looking and financial. So the real end game of TCFD is forward-looking financial metrics. And realizing between the financial service members and the non-financial service members that this is not very straightforward. To Michael's point, there's an alphabet soup of different standards. The TCFD has pulled together a set of recommendations, including metrics. But getting to, for example, a simple implied temperaturized metric requires a huge amount of data and the further development of methodologies. Sitting behind them has to be an understanding of scenarios and the data and the methodologies that drive those, and the level of information on your customer if you're a bank, or the investee company if you're an asset manager or an asset owner, that you simply don't have today. Where are the precise location of operating assets within that company? So we set ourselves a challenge to try and fix some of that during the course of this year and probably into next, and we will continue to keep people updated. As I was thinking about this, I was thinking about what do we mean by net zero? There are over 1,500 companies that have made net zero announcements, 50 plus governments, over 1,000 companies that have got science-based targets that they've committed to and are either developing them or have developed them. But when they make the announcement, what do they really understand net zero means? What is the challenge? How will they get there? And at what sort of pace? And if I move on to my first slide, this is our Net Zero Economy Index. We've been producing this for about the last 12 years at PwC. It is a combination of a long-run macroeconomic model and then a series of carbon transition pathways across about 50 companies. And so this is the global view: time across the bottom and carbon intensity as a normalizing measure of economies. And the good news is, on an intensity basis, not an absolute basis, we have been decarbonising over the last, sort of 20 years. Although obviously absolute emissions have continued to rise, just not as fast as economic growth. If we continue at the rate we achieved in 2019, then we will go along that top sort of path, the dotted line, and we will commit ourselves to somewhere close to 4 degrees of global warming from pre-industrial levels. And scientists will tell you that that will be pretty disastrous for the economy, for the environment, and for society. What we really need to do is to get all the way to the other end, the 1.5 degree decarbonisation rate, because that rate will get us as close to net zero as we can, with the balance being covered by offsets. And even the Paris Agreement only gets us to 2 degrees. And if you look at the NDCs that sit beneath them, probably at this stage only to 2.8 to 3 degrees. So the big hope for Glasgow, for COP26, has got to be that the targets are ratcheted up and to get us much closer to the 1.5 degrees that is embedded in the Paris Agreement and that scientists tell us is safe. So when I ask the question, what do companies and even countries understand by net zero? That is the challenge that companies have to go through. They've got to say, could I decarbonise on an average rate of 11.7% per annum every year for the next 2 decades? And that is a real achievement. When France converted to nuclear, they got to about 7%. The UK conversion to gas got somewhere similar to that. No economy has ever decarbonised at 11.7% per annum in history on a sustained basis. And therefore, this is going to be a very real challenge. And I hope the companies that have committed to net zero, including my own company, PwC, have really understood how it is that they're going to get there, what pathway they're going to choose, and when. And whilst the lines on this graph are beautifully smooth, we all know the reality is going to be somewhat different. The chances are that we will continue running on that dotted line, that we will have some sharp policy corrections, often in response to a physical climate event that mobilizes politicians to have more resolve. We saw that in the financial crisis with COVID. The problem with climate change is it's way harder to fix than fixing COVID. You can't simply make an intervention with medication and have a short-term lockdown on the economy and hope you fix climate change. So it is a very real challenge to get there. And therefore, I think we are going to see a point, maybe in the next 5 to 10 years, where there is a much more disruptive correction as policies are tightened. And it's that non-linear, potentially disruptive rate that I think is much more worrying for markets and for financial participants that operate within them. So that turns me to what is the role of finance. And to me, it's about providing the capital to help the economy transition from where it is today to where it needs to be in the next 10, 20 years to try and drive our economies down that bottom line. If I look at the sort of greenhouse gas reporting of financial institutions today, 80% of them, if you look at CDP data, will still talk about their own offices, their data centers, the air travel that their executives enjoy, possibly looking at some scope 3 emissions in their supply chain. Very few will say, this is the carbon embedded in our loan book, in our investment book, in our insurance underwriting. The role of the TCFD is to try and change that and to say, how do we begin to get to a point where there is financial, forward-looking reporting on the impacts of climate change, positive and negative, on our business as a bank, as an insurer, as an asset manager or an asset owner. And to do that, you've got to have much better reporting by what I've often called the real economy, the non-financial economy, because at the moment, if you are a lender or an investor, don't have the level of detail that you need to enable you to understand where is carbon in my balance sheet or in my investment portfolio, and therefore, how do I move that transition? If you look at the money going into renewables, it's been sort of annoyingly stable over the last 3-5 years, around about 300 billion a year going into renewables. The good news is that you're getting more value per $1 million because the price of most renewable technologies have fallen. So that's not to say that the rollout of renewables has stalled, but certainly the flow of capital going in has remained constant. If you look at last year, the amount of money going into the energy sector for transition finance was 500 billion. And the reason I make that point is very often I hear the argument about we're going to exclude certain sectors or certain types of assets. Coal has been the sort of victim of that over the last 5 years. And actually, what we need to do is to find a way of transitioning those assets from where they are today to where they need to be tomorrow. And whilst I absolutely agree that new coal in developed economies such as the UK or Europe is something that we probably should avoid, the reality is that if you are in India or China or other emerging economies, coal will form an important part of your energy mix, albeit on a declining basis over the next 20, 30 years, to enable you to have economic growth and to support poverty alleviation. And if you look at the IEA scenarios, there is not a scenario they've produced that doesn't have coal in it. So that might be a controversial statement for some, but the reality is we need to focus on transition finance as much as on green or brown finance. If I look at the European Union and their EU taxonomy and sustainable finance action plan, and I'm looking forward to the next variant that will come out in March, April, I think the point has been made that transition finance will be incredibly important. And therefore the sort of, green versus brown is a bit like having AAA and selective default as the only two credit ratings that you're prepared to understand. If I think about, therefore, what are the challenges, and I've just put up a couple of waterfall charts, which hopefully you can all see. I mentioned before that very few banks and investors really understand the detail of where their money is going. I was a banker for 21 years. If some of that, I was a relationship director looking out for my clients' interests. And the number of applications I wrote where the purpose was general corporate purposes. And why did I say that? I wasn't being evasive, but my client, the finance director or the treasurer, wanted liquidity. They didn't want a bank telling them how they could move that money and finance certain assets. And I think that is one of the challenges of the green bond market, if you talk to treasurers, that they really manage liquidity and access to debt. They don't manage asset level financing very often unless it's a very large, significant asset where they want to do some off balance sheet lending. And it's much the same as you're an investor. If you are investing in fixed income or in equities, unless you're doing real asset investing, you are investing in a portfolio of assets, some of which will be high carbon, some will be low carbon, and very many, frankly, you won't know the carbon emissions at the asset level. You won't know the location of the asset, so you have no idea what climate policy risks and physical climate risks your balance sheet or your lending book is exposed to. So people often say to me, well, the TCFD is about converting CO2 into dollars so people can understand. I also think it's about going the other way and saying, how do you convert a balance sheet where we have very long established, quite clear financial accounting norms that are understood by the producers of financial statements and the users of them, subject to audit, a lot of look through and transparency. How do you try and create the same if you're thinking about climate? And what I've got up in front of you is a restatement of a bank's balance sheet. I've removed the details to protect the guilty or innocent, depending on your point of view. And what it does is it restates the balance sheet into carbon emissions. So if I look at the left one, you've got a baseline of emissions that if the bank does nothing but grows at the rate that it has historically done, you will end up with that level of emissions within the balance sheet. And then you've got to look at, well, what different policy scenarios might affect me. So you need to understand your customer, where their operating assets located in the world, because that's where policy risk is, not in the head office, but in all of those operating assets. You need to understand the different policy scenarios in each of those countries that are being applied, and you need to consolidate that up. And then you simply need to do that for every borrower. Now, there are methodologies that are top-down, which is a good place to start. So thinking about how economies and sectors of the economy reshape. But ultimately, if you want to make a decision around engaging with a client, whether it be a client in a bank or an investee company in an asset portfolio, so that you can decide whether you're going to continue to support them with transition finance or at what point you may choose to invest, you've got to have that level of detail. And under these two scenarios, the first one is the current national policy scenario. You will get reductions because of those policies and very little effort, frankly, by yourself in retail lending, corporate banking, investments, etc. So you will be able to see a reduction in the carbon emissions in your balance sheet simply because of the actions that governments take to price carbon, put in place emission standards, remove petrol cars from the road, etc. And you will benefit from that as a provider of finance. That will probably help you remove maybe a third of the emissions in your loan book. So if you've made a commitment to net zero, which is based on an assumption that government policy will get you there, then you have residual emissions of possibly 60 to 75% of your balance sheet. And let's really understand what net zero means. It's about making a reduction in emissions as close to zero as possible, and then using offsets to get to net zero. And the math that we've done would say that if a bank took a current national policy scenario approach, then the cost of residual emissions in 2050, when one might expect an $80 to $100 price, would outweigh their net profits by at least threefold. So they will be signing a potential liability that is huge. So current policies aren't enough. What do you really need is you need a more ambitious scenario. And that scenario comes from two places. It comes from governments sticking to the commitments they make in COP26 and beyond To Michael's point, making sure that maybe using policy performance bonds issued by government, which I think was the original paper, if I remember it, Michael, to say if you default on your environmental policies, then you've got to expect to pay more for your debt, and therefore it gives you the incentive not to. So you need governments to stick to the targets that they agree, hopefully in Glasgow. But you also need to look at the mix of assets that you have within your portfolio and decide, am I going to provide transition finance to help those borrowers become more energy efficient, to convert to electric vehicles, to decarbonise production processes, lower carbon cement, lower carbon steel, etc. So that a combination of the economic move to low carbon, driven by policy, and your choice of investment, either investment to help a company move to net zero or divesting and redeploying, will get you much closer to net zero by 2050. And you'll then end up with a residual set of emissions, which are probably affordable within the cash flows and the profits of your institution, and will enable you to achieve the benefits of economic growth, which flow through to banks as providers of capital in terms of margin and non-funds income. It'll probably give you a very good role in terms of advising clients, because you've now got the insight to understand which assets they may want to dispose of, and therefore you've got a corporate finance advisory role, or to provide your balance sheet, or to give them access to the capital markets. And equally, if you're an investor, you'll begin to understand whether you're prepared to buy some of their debt or put money into their equities, because you believe that they are climate resilient in terms of their strategy. I wanted to sort of give you an example, and rather than making one up, what I've done here is extracted that example from BP. So BP do an annual energy outlook, and what I particularly liked about their most recent one was they've been quite candid about the different scenarios. So if I take you across these four graphs, starting on the left-hand side, they have looked at primary energy consumption by source under different scenarios. So you've got the 2018 mix, and this is the global consumption, not specific BP numbers. And then you've got a sort of a rapid scenario, so that's a sort of 2 degree scenario, a net zero scenario, therefore clearly more renewables, about the same with hydro, significantly less coal, and a sort of reduction in oil, natural gas as well. And then you've got the business as usual scenario. So they basically map to my 3 lines that I started this talk with. Then bringing it out into shares of primary energy supply, you can then begin to see how that affects, under those different trajectories, the growth of renewables. So blue being net zero, therefore the most aggressive growth of renewables and the most aggressive reduction in hydrocarbons. And clearly the other scenarios showing slightly more favourable outcomes for hydrocarbons and less so for renewables. They've then calculated a range of investment that would be required. So you can see under the light blue scenario, much lower investment in oil and gas and much higher in renewables. And you've got the ranges there, in the sort of 200 to 300 billion in a net zero for oil and gas, as opposed to a sort of 800 to 900 billion. But there still needs to be investment in oil and gas, even in that net zero scenario. And so again, my point on transition finance. And then the final one, just shows you therefore the annual investment in wind and solar in particular, and how what is the need of capital, again in dollar billions, showing clearly that a net zero scenario needs over $1 trillion in 2035 of capital. And so what BP have done here for the energy sector, not publicly for their own business, is to say, how does different climate policies drive different levels of investment and divestment that will reshape our business? And clearly, in terms of access to capital for them and to the sector, being able to tell that story so that providers of capital, the finance sector, are convinced that the assets will not be stranded and that there is a divestment plan which, somebody can participate in with finance, but really a redeployment of that capital that is owned by the shareholders and lent by the bankers that enables you to get return. So the sort of question we were asked is net zero a myth? I think hopefully what I've shared with you is it's not a myth, it is a reality, but it is a really quite tough reality. There are some easy wins, but getting down to that 1.5 degrees is a much bigger stretch than we are facing globally at the moment. The more companies that break down the national net zero plans that they're exposed to because of where they operate into their own strategies, the clearer they make, therefore, to lenders and investors and insurance underwriters that those plans are credible and consistent with a net zero transition, and therefore the enabling of the finance sector to also decarbonise because they're working with their clients and their investee companies to get there. And one of the sort of more simple approaches we've used is on the slide in front of you. They look like 4 rather easy boxes, typical sort of consultant oversimplifying things. But doing the impact baselining and working out what is the carbon content of my balance sheet is very difficult. The data doesn't exist. In some sectors it does. Household energy efficiency in developed economies often is publicly available or through subscription databases, but you try and look into the supply chain of a consumer goods company and work out what carbon is coming into their production processes, let alone the carbon imputed by the use of that product, can become quite difficult. But having done that, understanding, as I did with that waterfall, what are the different strategies in each of the different businesses I have that get me to net zero? And not just doing the quantification, but saying, how am I going to reallocate capital? If I think of carbon as a portfolio cap, a risk appetite limit on my balance sheet that is going to reduce over time, then how do I allocate that carbon across the different asset classes where I need to make sure that the different businesses will meet those carbon targets so that I can be on that trajectory to net zero. You can't set those targets at 2050. You need to look at what's my target in the next 5 years, 10 years, 15 years, and the Science Based Targets Initiative is one option to look at that. You've then got quite a large organisational transformation. There's the obvious stuff around embedding it into investment decision making, looking at product, services, R&D, etc., the infrastructure you need for a new business. But don't forget the people issues. At the end of the day, you've got to have the people within financial institutions that have this knowledge, that can have that value-added discussion with an investee company or a borrower, understand how their net zero strategy is or isn't going to be effective, and decide therefore whether to leave capital in place. And certainly, if the EU follow through on, for example, embedding ESG into the MiFID framework, then every investment manager is going to have to understand the ESG preferences of each of its customers. And then finally, I would not be doing either my own profession or the TCFD a service without talking about transparency and reporting, because without that transparency and the progress that both the finance sector and the non-finance sector need to demonstrate that they are moving in step with government targets which themselves will get us to net zero, then it is really difficult for the finance system to understand whether there are asset price bubbles or carbon bubbles building up. Final comment from me, the role of offsets. Michael spoke about voluntary versus compliance markets. You will not get to net zero in any organisation with current technology, let alone in a financial organisation, without using some form of offset. Mark Carney's task force on the scale of a voluntary carbon markets is very much recognising that net zero requires 100 billion a year of credits to be issued, and that's clearly a huge scale up. But you've got to have quality over quantity. There is no point having an offset that is not credible, that is not long term, that isn't just kicking the carbon problem down the road, as Michael described. Plant some trees and burn them in 25 years, and hope nobody spotted the fact that you were just moving a carbon liability from one accounting period to another. So making sure they're really good quality offsets, that they're permanent, that they are subject to good standards and they're verified to those standards will be absolutely key. And as a financial institution, understanding at what point you want to make that offset choice, because we're not talking about net zero today. That would be totally unaffordable for the sector, and in many cases will result in double and triple counting of offset requirements. But there will come a point between now and 2050, if you've made a net zero target at 2050, that you will need a really clear and credible carbon procurement strategy that enables you to genuinely say that those offsets are the equivalent to making the reduction where you couldn't. Final comment from me, what next? This has been very much a discussion around carbon and climate. If I think about the kickstarter for much of this at a policy level, it was the Stern Review, and it's taken to get to the TCFD, over a decade to get there. If I look at the Disruptor Review on biodiversity and natural capital, and the already formed task force on nature-related financial disclosure, I think the next big thing on the environmental side will be nature or biodiversity, way more complex than climate change, and climate is complicated enough. But that would be my forecast for the next 12 to 24 months. You could expect to see more action on nature, and it's just a shame that the convention that was going to be this year because of COVID is likely been pushed out to next year. So when I was listening to the video as we opened, they spoke about finance with purpose, something that really resonates with me. And for anyone working in the finance sector like myself, why do I get out of bed? Well, of course, I want to make sure that the capital flows into the parts of the economy that are required. And that if somebody leaves money with a financial institution, you'll give it back to them when they need it, maybe when they're retired, worth somewhat more than it's worth today, and hopefully with enough to live on. But in doing so, you won't have messed up the environment, that you'll have thought about how that money that you've been entrusted with is used to make the investments to drive us to net zero. And you'll have left a society that those people would wish to live in and retire to. Thank you very much.